Good morning, good evening, good afternoon, and welcome to the Booms and Bus Show. My name is Jonathan Davis, and as they say, we've got a packed programme today. Can I just first of all thank you so much for making last week's show the most downloaded show that I've done in 2017. That is absolutely fantastic, and of course I'm truly delighted that approximately 500 folk are now downloading the show, and indeed it's been regularly above 400 per show for the past few weeks. I'm recording this at just after 12:30 on Monday the 17th of April. This is the weekly Booms and Bus Show where we discuss capitalism, free markets, markets in respect of your investing for your pensions. We do a bit of politics as well. If you want to email me, please do so at jd@theboomsandbusshow.com, jd@theboomsandbusshow.com. Correspond with me also on Twitter at boomsbustshow. Follow me, spread the word, retweet the stuff that I'm tweeting, that I'm retweeting. Otherwise, others, your friends, won't get to know what you know. And think about it. If you like this show, they probably will too. And as I was saying last week, podcasting is accessible now everywhere. Many newer cars have got auxiliary points that you can download onto your mobile device and plug it into your car. You can listen to it when you're driving around. You can listen to it with your headphones when you're on the train going to and from work. You can listen to it in your lunch times. People need to hear what capitalism is all about, because all they normally get is cronyism and socialism. They say this is what we need. I hear so-called free marketers saying, oh, isn't it terrible that people haven't got a lot of money and this, that and the other. I say, well, of course it's terrible, but the solution is not more socialism. The solution is more capitalism. And I'm going to jump forward in something that I was going to be saying later in the show. Hong Kong and Singapore per capita GDP is now higher than that of France and the UK. Why? Because of free markets. Because they let the people just get on with it. Capitalism always helps the people. And if it helps the elite, then good luck to them. But normally, capitalism is to the detriment of the elite, to the benefit of the people. Today, on today's show, we're going to be talking about Turkey. A sad, sad situation. We're going to be asking the question again, are we headed for a recession? We're going to look at things, what are happening in final salary pensions. This is your pensions, folks, your parents' pensions. We're going to be looking at a couple of polls that I've been running on the Twitter account at Booms Busts Show. Again, we're going to look at markets and investing. We're going to listen to the quote of the week. That fascist, that socialist, that communist, that Marxist, that dreadful so-called human being, President Erdogan of Turkey, has just turned his country into a fascist state, using the same methods that got Benito Mussolini and Adolf Hitler into total autocratic power, where all they had to do was act like Caesar, lift their thumb, reduce their thumb, and someone lives or dies. An illegitimate referendum where I've tweeted actual officials stamping for the referendum, stamping yes, in front of those counting the polling slips. It's that illegitimate. Barry Shearman MP tweeted that the referendum was equivalent to the UK Brexit referendum. How dare he, as I tweeted back, compare an illegitimate referendum anointing a dictator, a fascist dictator, comparing that to the legitimate democratic referendum of taking Britain away from unelected bureaucrats. How dare he? Moving on, I want to thank Rob, Daniel and Malcolm for more information on the car loans saga. And indeed, alongside the tweet which announces this podcast on iTunes, as usual, I shall also be attaching other tweets and charts which I'm talking about during this show. The Twitterer Mine for Nothing helpfully tweeted the Telegraph write-up, and the headline was UK auto loans market spiralling out of control. So it's not just the US, listener, it's the UK as well. It's hardly surprising because our unsecured lending has also gone crazy. And it suggests to me, I did previously tweet that maybe the UK is 6 to 12 months behind that of the US. I think perhaps we're only 3 to 6 months behind that of the US. And the US is in a state of collapse in terms of their used car and therefore their new car market. I think we're only 3 to 6 months behind. I think by the summer or the autumn in the UK, our sales statistics, our prices statistics will be as bad as the US are right now. They are seeing their used car prices, according to their National Association of Distributors of Autos, falling over 3% a month in February, the most up-to-date stats that we have. I think we're going to see similarly within a few months in the UK. I saw 2 tweets a couple of days ago, and they were shocking that it was purely coincidental. They were consecutive tweets in my timeline. The first one was 100 million Americans are now on food stamps. That's practically 30% of the US population. Do not tell me that 30% of the American population needs to be on food stamps. Why is 30% of the American population on food stamps? because the massive companies that run the food stamps Ponzi scheme or scam, by the way, which is headed and led by JP Morgan, the biggest banking company in the world. Yes, they run the food stamps program, folks. They, of course, have used their cronyist lobbying system to build their empires and make vast amounts of money out of poverty. You couldn't make it up. We are living in postmodern dystopia. We're heading towards the worst dystopian science fiction movie you could imagine, which is already happening in many parts of the world. Oh, the caveat to that, of course, is that many parts of the world have moved out of vast poverty due to globalism and capitalism. But of course, in other parts of the world, particularly the Middle East, they have absolute obscene depravity, autocracy, fascism, anti-gay, anti-Jew, anti-Christian, anti-liberal thinking, anti-democracy. And yet somehow the lefties in the West tell us if we speak about that, we are the racists. We see the LGBT rallies and they've got posters for Palestine and Islam. You couldn't make it up. It's like the Jews voting for Nazis. It's unbelievable. Getting back to the food stamps. Just remember, folks, and this was what was shocking, because this was the very next tweet by an entirely different Twitterer on my timeline. Mussolini's fascism, by the way, aka socialism, got in under so-called democratic means because they promised food and jobs in return for higher taxes and higher borrowing. Need I say any more? Isn't it obvious what the heck is going on here? Socialism doesn't work. Capitalism does. I've talked about Hong Kong and Singapore. Capitalism always works for the many. Socialism works for the few. I've been hearing a lot about what's going on in final salary pensions, defined benefit schemes. There is, according to estimates, an underfunding globally in final salary pensions to the tune of $75,000 billion. $75 trillion. Now, the numbers are so massive, it doesn't mean anything to anyone. These are BS promises, listener. One day, I'm telling you, letters will arrive on real people's doormats saying, you ain't getting your pension you thought you were going to get. And as shocking as that is, don't tell me that folk don't know the reality of their own pension schemes. All they have to do is read the annual statements which they receive. And it shows that these deceitful liar BS accountants and actuaries are still assuming 6.5%, 7.5% net of all charges annual returns on investments, when they've only been achieving 2% per annum for many, many years, and that includes the massive stocks bull market since 2009. They've only been achieving 2% per annum. And B, isn't the thing about final salary pensions that they've got to match assets with liabilities, in other words, future pension payments? And isn't it, therefore, they've got to be investing in government bonds because they are as guaranteed as you're going to get income. So they get income in, they pay it out. But think about this. They're assuming 7% per annum growth. What's the annual return on government bonds? 2%. So what the heck is it that they're investing in that that somehow they're matching asset to liabilities, are they hell? And B, that they're going to achieve 7% per annum returns, are they hell? They are liars. They are deceitful guys working in these pension schemes. This is your parents, folks, your pension. And what are the governments doing about it? They're raising taxes. Why do you think your council taxes in the UK are going up? This is effectively property taxes to those of you listening around the world. Why do you think those taxes are going up? It's not what they say. It's not for the police. It's not for the disabled. It's not for the mental health. It's for their blooming pensions. That's what it's for. And once the council taxes can go up no more, they'll raise national taxes. Then what? You get 70% of the population who pay taxes. So really, no, you're looking 40% of the population that pay the taxes, taxes are going to go up through the sky to pay for those who aren't paying any taxes and also for those pensions. Can you see a problem with that? Because I know I can. And what's the result? Economic collapse. This is socialism in action, folks, where you take from Peter and you give to Paul, and you pretend it's for everyone's benefit. Remember Thomas Sowell. I don't have it in front of me, but it's something like, to understand politics, you have to understand politicians' motivations. Motivation number 1, get elected. Motivation number 2, get re-elected. Motivation number 3 is a million miles behind. Politicians do not care other than motivations number 1 and number 2. And how did this all happen? Because central bankers and politicians brought interest rates down to 0. They did massive QE, so it boosted share prices, which means that future returns are going to be nil. It's beyond obvious. It just takes 10 seconds of thinking about it. Now, I've done a couple of polls on Boom's Bus Show Twitter feed. A couple of weeks ago, I asked, what's gold going to be at by the summer? And worryingly, most folk agree with me. 43% said that gold is going to be closer to $1,500, pardon me, an ounce, rather than the $1,250 that it was a couple of weeks ago, or $1,750, and so on. And I also thought it's going to be around $1,550 by the summer. But I worry when a lot of people agree with me, and I'm not saying that facetiously. And over the last 24 hours, I did another poll on when is the UK going to raise interest rates. And worryingly again, more folk agree with me. I gave the options of interest rates in the UK would rise 2017 or 18 or 19 or the 12th of never, and I plumped for the latter, and 41% of respondents also said the 12th of never. The way I see it is that interest rates are not going to be rising soon in the UK, even though they're rising in the US. Why? Because the pound is actually in rally mode. It's rising strongly against the euro. It's rising against the yen. And most importantly, it's rising against the dollar. Nobody cares about really the pound. What they care about the dollar. And when the dollar is flat to falling, there's no way on earth that Mark Carnage is going to raise UK interest rates. Now, I've been having an online debate with a bloke on Twitter. Franz von Loo is his name. And this guy calls himself a macroeconomist. And he said, first of all, well, interest rates in the UK have to rise because, look, Brazil raised them and no one said they were going to raise them there. Brazil isn't the UK. The UK is the centre of the global banking cartel. And there's no way the banks are going to allow rising interest rates. He then came back with the amazing, yes, but we raised them heavily in 1990. In 1990, we were in the exchange rate mechanism. This guy calls himself a macroeconomist. I'm sorry, mate, but it seems to me you're a troll because you weren't having a serious argument. So what we're seeing is the dollar is gently falling. The yen is rising, and I've got a chart on that. And the yen's going to be very strong into the summer. The pound's going to be strong. The euro's even going to be strong against the dollar. And what have I said? When the dollar falls, commodities rise strongly. Now, in that situation, what we're likely to see as it happens is that, if anything, interest rates would stop rising in the US as the dollar falls. I'm talking about going into the autumn and the winter later this year. I'm still expecting, and indeed Goldman Sachs, by the way, now puts a 70% probability on the US rate rising again in March. So December 16, March 17, look out, June 17. But then if we're heading into recession, then they can reduce interest rates. Why will they reduce interest rates? Because heading into recession, the dollar will soar against basically every other currency, apart from maybe the Swiss franc. So, and of course, in that situation, as the dollar soars, we go back to disinflation or deflation. That's why I say, if the UK rate rises, it'll be in the 12th of never. I don't know when it'll be, but it isn't in the intermediate term. So, still with economics, very interesting. You know, I've been talking about the Atlanta Fed, who puts out weekly projections of what they expect the annual growth rate in the US to be in the year. Only 4 or 5 months ago, they were looking at 2%. By a few weeks ago, they were looking at 0.9%. By last week, they were looking at 0.6. This week, they're now looking at 0.5. I've been saying that could go to zero. Now, as it happens, it's probably bottoming around here at 0.5%. estimation for the year. It's probably going to rise, but it's on a falling trend, which is why we could yet see a negative expectation for US growth in 2017 from the Atlanta Fed. China, what a joke. China's GDP has come out at 6.9%, which is, of course, exactly what it has been for ages and exactly what they said it was going to be. What a total joke. Who on earth believes them? And to show you how much of a joke it is, Singapore, quarter on quarter, economic or GDP fell 1.9%. So how can Singapore GDP be falling, even if it's just quarter on quarter, not year to year, but even so, how can it be falling and China, it's nonsense. Can we be moving into recession? Well, I've got a chart here which you can see federal government receipts, 12-month rolling year on year, and it shows that there was a recession in 2001-2, and year-on-year government receipts fell. There was a recession, as you know, in 2008, and year-on-year government receipts fell, and year-on-year government receipts have just turned negative, minus 1.3% for the first time since 2008. Does this presage a recession? Not of itself, but stick it in your pocket and be entirely aware that this could be yet another indication that by the end of the year, the US and therefore everyone else could be heading for a recession. And I remind you what I said in my speech to the Freedom Association in, was it 2013 or 2014? I think it was 2014. I said that unfortunately 2008 is likely now to be seen as the hors d'oeuvre. The next recession, and I said at the time, is going to be in around about 2 or 3 years. Well, it's 3 years, is going to be the main course. Why? Because we've got bigger debts. Nothing has been sorted. We've got bigger problems. The can has been kicked down so far. That elastic has been stretched again and again and again. So, the next one's going to be a doozy, folks. UK British Retail Consortium year-on-year stats. UK sales down 1%. British Retail Consortium. When inflation is 3%, give or take, and yet retail sales down 1%, yes, it could be the Amazon, eBay, etc. factor. I don't think so, though. I think there's something afoot. I've been wanting to use this chart next. It's average cost for 4-year degrees in the US for a number of weeks. I've just decided I'm going to use it. It's not particularly relevant to anything particular, but just bear it in mind for how ridiculous A, our inflation stats are, and B, how costly our lives are these days. Stretching back to 1970, you've got the average cost of university degrees in the US. The black line, it was this is in current dollars. I don't know what the current dollars is. It was $26,000 for a degree back in 1971. It's now $86,000. That's the average. Don't tell me living costs are reasonable. Don't tell me that the poor and the middle class isn't most affected by government actively inducing inflation. because the middle class and the poor are the most detrimentally affected. The poor haven't really noticed it because they've been given vast handouts. The middle class hasn't really noticed it because they've been taking vast debt. The stupid idiots that they are. The next chart is China's debt. And it shows percentage debt of the size of the economy. So, forget the amount of trade that China does. Forget the vastness of the number of cars sold, the number of motorways that they have, the number of high-speed trains, their rocket launches into space and the moon, and forget all that. It's all in relation to the size of their economy. And you see Japan and Spain there. When it got up to about 220% of GDP, that's when Japan and Spain gave up the ghost and went into depression. And now, this chart actually only takes us into 2015, and it shows China's debt at just over 200% of GDP. I said to you last week, and if you look at the charts that I tweeted last week, China's household and business debt as a percentage of GDP is now 220%. So I wanted to show that, and as the title says, the 100 trillion renminbi question: what happens after China's debt ratio peaks? Well, as far as I'm concerned, it probably has peaked. Does that mean it can't go even more extreme? No, it can go even more extreme. But this is yet another thing we need to be aware of as to why, by the end of this year, everyone could be going into recession. Now, I didn't have time to look at the housing market last week, so I make sure I have got time this week, because I know this is a particular interest to listeners. The second podcast that I did this year, I discussed briefly the housing market, and that was by then the most listened to podcast of the series. I'm delighted to say that actually last week's show is now the most listened to podcast. It appears that the Booms and Bust show is getting some steam, and I thank you so much, listener, for telling your friends and acquaintances and retweeting, so that other people can get to hear about it. The first chart there is the Toronto home prices chart. I mean, it's just unbelievable. It shows that Toronto house prices in March were up a third on the year before. And this, of course, after 20 years of crazy house price rises. If that isn't a bubble, I don't know what is. And these things will sort themselves out. Just because something is in a bubble doesn't mean that it has to crash imminently. No, UK house prices have been in a bubble now for 10 years. And the bubble has been kept going by zero interest rates and Help to Buy. And nothing else. And in due course, even these will not be sufficient to keep the bubble going. As far as I'm concerned, the powers that be have now shot all their bullets. And this is the big issue, chaps. In the next recession, house prices will fall as they did in 2008. In 2008, prices in London and the southeast fell just over 20%. and more as you went outwards from there. And indeed, I think the biggest falls were seen in Northern Ireland because, as it happens, in percentage terms, they'd seen the biggest rises. So house prices in the next recession across the country will likely fall 20-25%. To which you say, if you are one of those who have benefited from decades of house price rises, well, I can handle that because I bought this house for 30,000, 60,000, 100,000, and now it's 300,000, 600,000, a million. Ha ha ha. Aren't I an amazing investing genius? No, you're not. You're just lucky. I can handle that because then house prices will rise again and I'll be able to retire in the future and go to Barbados. No, you won't. Because what happened in 2008, which I believe was the end of the 40-year boom in house prices, was they slashed interest rates from sizable to basically nothing, and also they printed vast amounts of money, and then as house prices were about to fall over a cliff, they brought in Help to Buy. Now, the next time, they cannot slash interest rates. It literally can't happen. They're already practically zero. Sure, they'll cut them to zero from 0.5%. Sure, they will. They might even go negative. But I can guarantee you that move will not boost house prices. Secondly, they'll do massive QE. Indeed, it will be a multiple of what they did in 2008. It'll be that ugly. But QE does not help house prices. It helps other things like the banking system, bank share prices, the stock market, but it doesn't help house prices. And yes, they will probably do Help to Buy again. And let me remind you that Help to Buy is essentially where you can borrow 20% direct from the government. And then 5% deposit, you got 25%, and then you borrow 75 more from the Bank or Building Society. Of course, you're borrowing 95%, but a fifth of it is coming from the government. By the way, what's communism? The UK housing market is communism because the government is funding it. In order for Help to Buy Mark II to help in the recession that I'm talking about, and by the way, in that recession where interest rates cannot fall, it'll be a true recession. Not only will the stock market crash, but businesses will also crash, job losses will rise big time, and houses will be repossessed big time. In that scenario, Help to Buy Mark II would have to be not borrowing 20% from the government, but I envisage it would have to be borrowing 50% from the government. Is it possible? Yes, it's possible. Is it likely? I would say to you, even that is not likely. Even what we know about corrupt politicians and central bankers, I would say to you it's not likely that they'll set up a scheme where you can borrow 50% of the purchase price of a house directly from the government. However, I've been wrong before on what governments do, so anything's possible. Land registries. So, basically, if you're looking to buy houses right now, you're a numpty. Don't even look. If you are up to your eyeballs in houses and mortgage debt, you're a numpty. You want to get rid of it. This is not investment advice. This is general comment. Land Registry stats. As of December, they're always a few months behind. As of December, England number of houses sold was down 19% in December 16 compared to December 15. And by the way, London was down an astonishing 31%. The London market is not collapsing, it's in a state of collapse. And this is before a recession. I am a tenant is a Twitterer, and his tweet account is called I_tenant. He tweeted, for your information, leveraged buy-to-let landlords who can't sell because they mewed the mortgage equity withdrawal time after time in order to buy new properties, because they mewed all their unrealised capital gains. So now that they've got no capital gains, they're up to their eyeballs in debt. Sorry, they've got capital gains, they've got no further capital gains. They can't sell because they've got capital gains on their books that if they sell, they've got no money, but they'd have to pay a lot of tax. As he says, you are now being boiled alive because of Section 24. What is Section 24? Well, this is what I read. Headline, 6th of April. Almost half of victimised buy-to-let investors ready to quit. Victimised? Are you having a laugh? A new study of landlords reveals that far more believe they will be affected by today's 6th of April buy-to-let mortgage interest tax relief changes than government estimates. As I say, I wanted to do this last week, but I'm doing it on the 17th of April. 40% of buy-to-letters plan to quit the rental market by 2020, fearing they are being unfairly targeted. Unfairly! 21% said they plan to sell all their rental properties, 10% will reduce the portfolio, and 7% will switch to commercial property ownership, limited company, as opposed to just doing it on a self-employed basis, because apparently limited company property ownership is perceived as a safer option. A further 8% say they will transfer ownership of their rental property to their spouse or another family member who's in a lower tax bracket. 2/3 of landlords surveyed said they feel stigmatised, my goodness, for running a rental business, and just over a half directly quoted government policy as a source of this stigma. Stigmatised, victimised. Do you not realise you have been handed money hand over fist for 20 years? And when you were in a state of collapse, they bailed you out. They brought interest rates down to zero. Then they did Help to Buy, which boosted the market again. They bailed you out twice in 4 years. How dare you suggest you've been victimised and stigmatised? Guy from an insurance company says, we see a real confusion as to what the new tax changes will mean, with government and landlords giving very different estimates of the impact. We need to remember that few landlords are professional property tycoons. 2/3 in the UK are accidental landlords. Well, you pay your money and you take what you get. And if you are shafted, tough titty. You made your bed, you lie in it. You think you're investment geniuses, you're not. You've been lucky, you've been bailed out time and time again. And If the investment conditions change, well, what can I say? Interest rates still the lowest in 5,000 years. You had plenty of time to do something about it. And finally, we get to markets. I need to take a glass of water and calm down. Wipe that fevered brow. Victimised landlords, how dare you? The first thing I'm looking at is the yield curve. The what? Can you talk in English, Jonathan? I will, but only if you tweet me at Booms Busts Show and correspond with me and retweet what I'm tweeting and get involved with the polls. And also email me at jd@theboomsandbustsshow.com. The yield curve, technically, it shows us in pictorial form whether or not the global markets believe that inflation is going to be rising in the longer term or falling. And of course, if the global markets believe that inflation is going to be rising, then that suggests a stronger expected economy. If global markets believe inflation is going to be falling, then that suggests they expect a weaker economy. And what we do is we look at the 10-year rate, which is the rate at which the government borrows over a 10-year period, and we take away the rate of the government borrowing for 2 years. So it's the 10-year rate less the 2-year rate. That gives us the differential, obviously. And from that, we can plot a chart. And I'm showing you the chart of the yield curve back to 2005. I want you to look on the left-hand side of the chart. You will see that in 2006 and 7, the yield curve went negative. In other words, the 2-year rate went higher than the 10-year rate, suggesting that the market believed that there was going to be lower inflation in the longer term. And sure enough, there was. Indeed, we went into the 2008 recession. Then we saw the yield curve go positive again. But note that since 2010-11, the yield curve has been gradually trending down. And indeed, by the summer last year, it was at its lowest point since 2008, in fact. And it's bounced since then, but it's trending down again. The point is, since 2010-11, we've seen lower highs and lower lows. That is the classic definition of a downtrend. And in the right-hand side of the chart, you see a mini chart zoomed in the last few months. You can see how it has crashed in the last few months. We are heading to zero. In the next few months, unlikely. Within 9 to 18 months, I would say it's likely, based on the trajectory, not based on any of the economics that I've discussed, not based on Brexit or Trump or Syria or Turkey, nothing, just based upon what the bond market is actually doing. And let me remind those chart skeptics out there that the chart is the sum total of all the global market knowledge. The multi-$10 trillion market is in that chart. And the bond market is 5 times the size of the equity market. And the bond guys are smarter than the equity guys. So, just go with it. We're going negative in the next roughly 9 to 18 months, and that strongly suggests a recession. And the recession is likely to be, I'm afraid to say, a doozy. So, if you haven't got your house sorted out, pardon the pun, if you haven't got yourself sorted out, well, you have been warned. I'm going to skip those things. I'm going to move on to, you see, this is what's so funny. The market, as of March, is actually pricing in less than a 10% probability of a bear market within 12 months. The market is hugely bullish. Well, that's fine. It's hugely bullish in the short term. It's funny because the stock market is actually coming down. I've been saying for the last few weeks, we're looking at a 10 to 15% pullback correction. We've already had at 3 or 4%. Over the next couple of weeks, I think we're going to see a 5 to 10% pullback on top. And then you will see there being much more bearishness in the market because the market normally does the opposite of sentiment. Sentiment a few weeks ago was hugely bullish. Interestingly, the market's been falling since then. The bullish percentage index shows the percentage of S&P 500 constituents who are above or below the 50-day moving average. And as of Thursday, the close of play Thursday, obviously we've just had Easter, the percentage had fallen from 80% to 71% above the 50-day moving average. Now, you can see the sharp fall in the right-hand zoomed-in chart. Now, it seems to me that is going to go down to the lows of at least November of last year, June, July last year, maybe even January of last year. And as we go down, you will see the number, the index itself fall. This is one of the many reasons why I'm looking at an overall 10 to 15% fall in general stock markets. Moving on to gold, which means I'm going to talk about the dollar yen. Well, look at the dollar yen chart. You can see that the dollar soared from 2011 to the end of 2015. What did gold and silver do? They crashed. From the end of 2015 into 2016, the dollar fell. And what did gold and silver do? They soared. In the second half of last year, the dollar rose against the yen, gold fell. And indeed, in the last few months, we've seen the dollar falling against the yen. And what have we seen? We've seen gold rising. We see a lower high in the dollar yen in 2016 compared to 2015. It does seem as if the dollar is on a falling trend against the yen, which means, of course, the yen is rising. Go to the next chart and we see gold rising. And indeed, gold just on Thursday and indeed in the overnight in the futures market, we saw gold get to $1,296 an ounce. Just on or just below the falling trend line at 1,300. It seems to me it's not quite going to get above that falling trend line, the resistance line immediately, but it seems to me within a couple of weeks we're going to blast through that falling trend line. We're going to get above $1,300 and yippee-yi-yay, we're going to see a massive move into the summer. $1,500, $1,600, maybe even $1,700 an ounce by the summer or the autumn. Absolutely massive. You can imagine what that's going to do. You can imagine what that's going to do to mining shares. And indeed, the chart there of the silver to gold ratio. When silver's rising against gold, precious metals in a bull market. Well, that's a massive resistance for silver against gold to get up above. If it does, then I tell you, precious metals will be in a multi-year bull market. Put that in your pension and stew on it. Ladies and gentlemen, I've had 55 minutes even, of a blast. I've enjoyed myself tremendously. I hope you've enjoyed it again this week. I hope you're telling people to listen in. As I say, they can do so in the car, they can do so in the train, they can do so when they're out jogging, they can do so in the fitness rooms, they can listen when they're having a bath. Hey, I was in the bath this morning and I was listening to a podcast and I even tweeted I had Joe Fahmy in the bath with me. Let's move to the quote of the week. Do you remember George Carlin? Great anti-establishment stand-up comic. Truly great man. May he rest in peace. He died some years ago. I'm going to leave you with his words, and when I finish, that's the end of the show. Ladies and gentlemen, thank you so much for listening. Tweet me at Booms Busts Show. Email me at theboomsandbustsshow.com. This is Jonathan Davis of the Booms and Bust Show signing off with the quote of the week from George Carlin. Governments don't want well-informed, well-educated people capable of critical thinking. That is against their interests. They want obedient workers, people who are just smart enough to run the machines and do the paperwork, and just dumb enough